it's time for critical thinking. And what do you have?
I want to talk about inflation and inflation expectations as they relate to interest rates. So we've talked about this a little bit before. So interest rates equal expected inflation plus real return. So your interest rate that's quoted in the paper or you talk to somebody about is a nominal interest rate. And you can break that into two components. The one component is your expected inflation. So if I lend you money for a year and you think prices over that year are going to go up 10%, the minimum you would lend me money at is 10%.
Oh yeah, just base.
Well, that would break even, right?
Break even.
Because if prices at the beginning of the year cost 10% or 10% less than at the end of the year, you want to make sure if you lend $100 and prices are going to be $110 in the future, that you get at least $110 back for your money. Well, that's break even. So the inflation expectations equal the interest rate, you get no real return. Does that make sense?
I would like a return.
That's right. So your return is going to be based on how risky you think the other party is and how likely it is you'll get your money back. So Greece, you're going to have 200% return, and in Germany, you have a 1% return. So let's look at our 10-year. So our 10-year treasury is going, it's under 2%, but in round numbers, let's just say it's 2%. Okay, so it's paying 2% interest. What do you think inflation is? I'd say no more than 3%. It's not zero, it's probably close to 3%, right? So let's just say, I mean, that sounds reasonable.
Yeah, 2.5 to 3%.
Okay, so if inflation is 3% and the interest rate quoted is 2%, what's our real return?
It's
minus
minus
1%, right? 3 minus 1% is 2%.
Okay, I see what you're doing.
You see what I'm saying?
Yep.
So the real return on lending the government money, you lose 1% to lend the government money at this rate. Now, why would you do that?
Safety.
Safety, exactly. Very good. You get an A. It's safety. The reason people are flocking to the 10-year isn't because they're making any money. They're losing money on the 10-year. The reason they're doing it is because they know they'll get the money back, and they'd rather have minus 1% and their money back than to put it any other way. So you want to know if the world is risky or not? People are losing money by putting their money into the government treasuries because they're scared out of their wits that they won't get their money back everywhere else. So...
Well, what about Italy?
Oh, okay, good question. So this is the U.S. Treasury. So let's do the 10-year Italian bill. So they're going about 7%, right? I mean, that's about what they're going, a little bit less than that right now. So 7%, what do you think inflation is in Italy?
I don't think there is inflation in Italy.
Well, they're going into recession, right?
Yeah,
so prices aren't going up. So let's just say inflation in Italy is probably zero. They're going into recession. They've got all this austerity. Prices can't be rising, right? They should be falling, actually.
Correct.
Okay, so their real rate of return in Italian would be 7%. So the difference between the U.S. and Italian rates isn't 7% or 5%. It's actually 8%.
Yes.
So the spread's actually bigger than that in the real return. So when you think about things that are impacting interest rates, you can't just think about them nominally. You have to think about them in terms of inflation. But that's not where we could stop, right? So these are two government bonds. Let's talk about corporates. So let's take let's say a AA corporate. Last time I looked at AA corporates in the United States, they're paying about 3.5%. So, and we have 3% inflation. So AA corporates are giving you about 0.5% return. Right? So there's a little bit of money to be made in corporates, probably better than other things, which is why they're probably come down, and why a lot of investors that are a little more savvy about the bond markets are looking at things that are a little bit less than AAA, but still investment grades that are safe, because they're at least making some real return.
Better than nothing.
It's better than nothing, right? Exactly. Now, that's with inflation where it is now.
So what if the expectations for inflation were to rise?
Right. So that's a good question, right? So if we change these numbers and expectations rose, let's say they rose 3%. If they rise 3%, instead of having 3% inflation expectations, we have 6. And 6, with a minus 1 real return, if that's what we still want, would give us a change here in our 10-year of 5%. So instead of having debt at 2%, which is very fundable and not a problem, or at least it shouldn't be for us at this time.
Right.
Inflation expectations going up 3% would change our debt structure to 5%. It would take our interest payments and more than double them. So now you worry about how much debt the United States has. It's not so much that people wouldn't lend us money, but think about the impact of inflation expectations on our $15 trillion worth of debt.
Car payments,
Everything.
house payments.
Everything goes up. Inflation, if it's 3% in Italy and it goes to 3%, all of a sudden they're at 10%. And in corporate bonds, they go to 6%. Now they're paying at 6.5%. And so the funding cost for companies to build a new plant and equipment, to expand their operations, to build new stores, whatever else it is, basically doubled. So inflation expectations are crucial to controlling the amount of interest expense in the economy, because we don't get anything for it. It's just, you're just passing along the costs. That's why we don't like inflation. It hurts us in many, many ways. We don't like inflation at all. We don't want this. We don't want this. We want inflation expectations to be maintained and under control, which is why you see people pushing constantly against more quantitative eating, more inflation, because if inflation gets out of control, it impacts everything, and it can be really, really bad.
And what's your takeaway?
So my takeaway is interest has two components, a real return and an expected inflation. Be sure you consider inflation when you invest or when you borrow money. It's crucial to your real return.